exercise. Any exercise price in the option. These are the things that will make up this liability. That amount to discount. Remember, these are the future money I will be paying. Future money I will be paying. Therefore, this is what I will discount to get the lease liability. That is what we discussed, and also we discussed on subsequent measurement. Subsequent measurement, I say that the right of use will be depreciated. This amount will be depreciated. The right of use will be depreciated on straight line basis. We depreciate it on straight line basis. Then the lease liability will be amortized. The lease liability will be amortized. And I did mention that the way amortization is done is dependent on when payment is made. I said there are two types of payment. There are two types of payment. When you are into this contract, you can start paying in advance or you pay in arrears. Therefore, those two will inform us on how to prepare the amortization schedule. I can decide to prepare to pay in advance or I pay in arrears. Then there's a question we were doing there. I just want us straight to go to that question. There is a question we were doing, although we did not finish because of the constraint of time. We did not finish, therefore, I want us to continue with it. We finish, then we look at another question, we do another one, so that we internalize this concept. This question read like this. A Limited entered into 20 years lease of a building with an option to extend for a further 5 years. This payment of shillings 80,000 per year during initial term and 11,000 per year during the optional period. Optional. I saw somebody writing his own things. I said optional period. Optional period. Period. All payable at the year end. At the year end means all payable in arrears. All payable in arrears. All payable in arrears. I can hear some background noise. Therefore, it's good that I mute you all. All payable in arrears. That is at the year end. To obtain the lease, A Limited incurred initial direct cost of Kenya shillings 25,000. At the commencement date, A Limited concluded that it is not reasonable to extend the lease. The interest rate implicit in the lease is 6%. Required. Show how A Limited will account for the above transaction. Show how A Limited will account for the above transaction. Therefore, how are we going to account for this transaction? How are we going to account for this transaction? Show how A Limited will account for this transaction. Therefore, the first thing we do in a lease, in a transaction of leasing, is to get the lease liability. The first thing you get is the lease liability. And I believe because you have these figures, we determine the lease liability where we do 80,000 into bracket 1 minus into bracket 1 plus 0.06 raised to negative 20 divided by 0.06, of which you gave me 917 point some blah blah blah. You gave me 917 blah blah blah. What was the 917? I believe you gave me that figure. Kindly, Jen, you can help Malimu there. We already got this 594. Thank you very much. 594. Therefore, that was the lease liability. Lease liability. Then our right of use was, I will take 917,594 plus direct cost of 25,000, direct cost of 25,000, so that I get how much? That is 942,594. That is the right of use. We add. That is the right of use. You add right of use, right of use. Therefore, my right of use, we said this one we depreciate on subsequent measurement. ROU is depreciated. is depreciated. Therefore, I take 942,594 divided by 20 years, and 20 years. When you divide how much is our depreciation per year, let's go quickly. We have these figures because we did up to somewhere this question. Let's go quickly. You have these figures kindly. When you take 942,594 divided by 47,130, thank you very much, 47,130. Therefore, at the end of the year, my carrying amount equals to 942,594 minus 47,130, 47,130 like that, 47,130 like that. Therefore, that is how you report the right of use. Then we say the lease liability will be amortized. Therefore, let's quickly amortize the lease liability. Lease liability, we amortize this liability. Therefore, let's amortize. This one will amortize. And to amortize depends on when are we making the payment. Is it at the end of the year or at the beginning of the year? Like this one is at the end of the year. Therefore, we shall say year principal balance. Principal balance. Then we have here interest. Then we have installment. Then balance carried down. Balance carried down. We are only doing for 2 years. Don't make it for 20. We are only doing for 2 years. Examiner wanted us to report for year 2019. Then we are only doing for 2 years, for 1 year. Therefore, let's prepare, although we are preparing for 2 years, but we required it for 1 year. Therefore, here, on my amortization schedule in year 1, my principal balance is the lease liability, 917,594. Then interest here is 6%. Interest is 6%. Installment we are paying each year is 80,000. That was the amount we paid at the initial term. At the initial term, we paid 80,000. Therefore, we can give us the interest on 917,594. 917,594. That interest I'm getting 55,006. I'm getting 55,006. I don't know if that is what you have. 55. Like that. I don't know if that is what you are getting. 6% of this, 917. So 55,055, 55,055 like that, or 56. 55,056. Thank you very much. 55,056. Now, what I will do, I take 917,594 plus 55,056. Then I subtract 80,000. 80,000. I'm getting 892,650. That is what I'm getting at the end there. That is what I'm getting at the end. In year two, I have 892,650 times 0.06 there. I'm getting 53,559. I pay 80,000 like that. I pay 80,000 like that. This is 6% of this. Don't ask me where are you getting 53,559? The 6% of the opening balance. Then when I add plus I'm getting 866. 209, 866, 209, 866, 209. Therefore, this is the finance cost. This is the liability. That is the finance cost and the liability. Now, remember, the examiner wants us to show how to report. Therefore, what are we going to represent in this list? Number one, the depreciation. Depreciation. Number two, finance cost. Finance cost. You show the finance cost. Number three, the ROU, the right of use. Then number four, the lease liability. You show the lease liability. These are the crucial items that you are required to show us in the list. Crucial items that you are required to show us in the list. Now let's see financial statements. Let's prepare the financial statements. Financial statements there. Let's prepare the financial statement extracts. Because up to there we are not yet done, we must prepare financial statement extract. Now let's prepare P&L, financial statement extracts. Extracts, we begin with P&L. P&L extract here. And number one, we are going to report is the finance cost. Finance cost. Now, finance cost in our year one is 55,056. That's our finance cost number one, 55,056. Then number two, depreciation. Depreciation is 47,130. 47,130. Those are the items you present in the P&L. Those are the items you present in your P&L. Let's do the balance sheet. Balance sheet. Statement of financial position extract. The balance sheet extract we have here there. Balance sheet extract under non-current assets. Under non-current assets. I believe we are moving together. Under non-current assets. Here we have the right of use. Right of use, asset under non-current assets, where I will take 942,594 minus 47,130 minus 47,130. How much am I going to report there? That is 942,594 minus 47,130. 47,130 there. And 942,594 minus 47,130. 895,464. That is what I report at the, thank you very much, Ruth. That is what I report. Then I come to finance by section. Financed by section. Under non-current liabilities. Non-current liabilities. Under non-current liabilities here, I have the lease liability, which is long-term. Then also I have current liability. Current liability, where still I have lease liability to report there. This liability. Now I want to explain something on that crucial items. This is the point you need to listen very carefully. You leave whatever you are doing there so that you listen to this very carefully, because in the next question you will be asking me, why are you doing this? But if you understand this, then you will not ask me that question, because I may end up not answering you because I want to explain here. Now, under IFRS 16 leases, when we are preparing the amortization schedule, and the payment is made in arrears. Payments are made in arrears. What does it mean? When payments are made in arrears, examiner has asked you 1 year, has asked you year one. Listen very carefully. Examiner has asked you year one. you must prepare for and with also year 2. You must prepare for year 2. When examiner asks you year 1, kindly listen. You prepare also year 2. Why are you preparing for year 2? You prepare year 2 because the liability for year 2, like this one, is the non-current liability in year 1. The liability of year 2 is the non-current liability of year 1. Like in this case, I'm going to report 86,6,209 as non-current liability in year 1. I take for year 2. Remember, we were asked to prepare for year 1. You must prepare for the subsequent year. What will be the impact? The liability for year 2 is the non-current liability for year 1. When I come to the current liability, I will take the difference between the year 1 and year 2. The difference between this and this. The difference, what is the difference, my good friends? The difference is 892, 650 minus 866, 209. It is 26,441. 26,441. Therefore, what I'm saying, I'm insisting is when you are preparing amortization schedule under IFRS 16, the payment is made in arrears. In arrears means it's made at the end of the year. Then, when examiner asks you year 1, you prepare for also year 2. If he asks you year 2, you add year 3. If he asks you year 3, you add year 4, like that, like that, like that. So, like when we are in year 1, the non-current liability for year 1 will be the one for year 2. This one, the one for year 2. Then the current liability is the difference. Current liability is the difference. But when payments are made in advance, listen very carefully. I say this one, we need to listen very carefully. When payments are made in advance, then when examiner asks you year 1, you only prepare for that year. The one non-current liability will be, for example, in this case, it will be 9,892,650 minus the installment of 80,000. The non-current liability will just be the one at the end like this, then minus what? Minus the installment, if payments are made in advance. Then what will be the current liability? The current liability is the installment, these installments. If payments are made in advance, the installments becomes what? The current liability. I believe that one is okay. Therefore, this is what you are required to do for you to understand leases. Let's look at another simple question. But now what we are going to look at, if payments are made in advance at the beginning of the year, in advance, which is at the beginning of the year. Therefore, quickly just write something small there, something very small, so that we move together, something very small, so that we move together, right? You say A limited, you say A limited prepares financial statements, A limited prepares financial statements as at that 1st October each year. A limited prepares financial statements as at that 1st October each year. A limited prepares financial statement as at that 1st October each year. On 1st November 2018, on 1st November 2018, A limited list a property, A limited list a property, A limited list a property, A limited list a property on 10-year lease agreement, on 10-year lease agreement with Delila Limited. On 10-year lease agreement with Delila Limited, with Delila Limited, with Delila Limited. The annual lease payments were Kenya shillings 2.5 million. The annual lease payment were Kenya shillings 2.5 million, 2.5 million. The annual lease payment were Kenya shillings 2.5 million. Kenya shillings 2.5 million, 2.5 million. If I was you, I write 2,500, Kenya shillings 2,500, that is 2.5 billion. Our shillings is in thousands, 2.5 million, 2.5 million, 2.5 million, that's our annual lease payment. Payable in advance, payable in advance, payable in advance, payable in advance. The first installment being made on 1st November 2018. The first installment being made on 1st November 2018. Limited, INGAD, initial direct cost of 500,000. Limited, INGAD, initial direct cost of 500,000. Limited, INGAD, initial direct cost of 500,000. 500,000 in arranging this lease, and receives an incentive of 250K thousands, and receives an incentive of 250K. The annual interest implicit in the lease is 10%. The annual interest implicit in the lease is 10%. The annual interest implicit in the lease is 10%. Required. Show how Limited will report the above in year 2019 and 2020. Required. Show how Limited will account for the above in year 2020, 2019 and 2020. That is, those are 2 years, year 2019 and 2020. Year 2019 and 2020. Therefore, first thing we do the analysis of this question. The first thing we do the analysis of this question. Whereby we do the analysis, whereby Limited is the lessee. Limited is the lessee, that one we know. Then we have the lease period. Lease period is 10 years. 10 years. Lease period 10 years. Lease payment, that are the installments. This payment is 2,500, that is 2.5 million, 2,500. Then we have direct cost. Direct cost was 500K. Direct cost 500K. Incentive is the discount. That's the discount. 250K. Incentives, these are the discounts you get. 250K. What else do we need in our analysis? What else? Interest rate implicit. Interest rate is 10%. Interest rate is 10%. Interest rate is 10%. Therefore, those are the analysis, the items we have in this question. Now, where do we start exactly? Where do we start? Now, in such like a scenario, you need to give me what we call the lease liability. Starting point. Let me write here the word starting point. Starting point. Starting point, that is on initial cognition. You need to give me what we call the right of use. The right of use. And the lease liability. Lease liability. But of course, we begin with the lease liability. Of course, we begin with the lease liability there. You begin with the lease liability because the right of use will be the formation of the right of the lease liability. Therefore, let's get the lease liability. Lease liability. Let's get the lease liability. This is the present value of minimum lease payments. Present value of minimum lease payments. Present value of minimum lease payments. Now, if it's the present value of minimum lease payments, then I'm going to discount the minimum lease payments, which is 2.5 million, to get the this liability. Therefore, I'm going to take 2,500 like this into 1 minus into 1 plus 0.1. That is my interest rate raised to not negative 10, raised to negative 9, raised to negative 9. The whole thing we divide by 0.1, 10%. Interest rate implicit is 10%. Now, I want you to listen also here. I want you to listen here kindly. If whatever you are doing to listen, because you'll be asking me a question that I will not answer you. Now, in our past, when payments are made in arrears, when we were discounting, if it was 20 years, we were putting here 20 years. If it's 10 years, we put 10 years. If it's 5 years, we put 5 years. That is when payments are made in arrears. In arrears means at the end of the year. But if payments are made in advance, when you are discounting, our end, the number of years, you always subtract 1. You always subtract 1. My good friend there, you always subtract 1. Why are you subtracting 1? Because remember, the first installment you have just paid at the beginning of the year, which means you are done with the first year. You are done with the first year, the first installment, memalizana. Therefore, you will not be required again to discount. That's not the future money. Whatever you are paying today now is present money. It's not future money. That we don't discount it. We only discount what we shall pay in future. But remember, here, the first installment I'm paying at the beginning of the year. Therefore, when I pay, I remain with 9 years. Therefore, 9 years is now the future money. Therefore, you shall always subtract 1 if you are making payment in advance. But if it's in arrears, when it's 10 years, all the amounts will be paid in the future. I believe that one you have it. Therefore, who is a good student to give me the present value there? To give me the present value. My good friend Ruth, kindly let me first get that one. I will take 1.1 raised to negative 9. The whole thing 1 minus answer. Then answer minus answer divided by answer divided by 0.1. I get 5.7 something, 5.7 something times 2,500. I'm getting 14,398. I'm rounding off. Thank you very much. 14,398, like that. Therefore, my lease liability is that amount. That's my lease liability. Then I come to the right of use. Right of use. Now, when you come to the right of use, my good friends, I will take the lease liability. Here you take the lease liability, which is 14,398. I come to add direct cost, direct cost by the lessee, which is 500. Okay. Then I come to less any incentive. We had an incentive of 250K. We had an incentive of 250K. We had an incentive of 250K there. An incentive of 250K. Then I also add first installment. First installment, because I'm paying it, it's not part of the liability. First installment, I'm paying it right away. It's not part of the liability. Therefore, I come to add 2,500. That's the first installment. Why am I adding it? Remember, I have just paid it, and it's not part of the liability. Therefore, when I'm consolidating my whatever I paid, it is part of it, what I paid. Therefore, I put it there. 14,398 plus 500 minus 250 plus 2,500. I'm getting 17,148. 17,148. Therefore, my right of use is different from the lease liability because of other costs that we included. We included the initial direct cost. We included the incentive on payment. Then also we add the first installment because it's the amount we have paid and it's not forming part of the liability. Now that is the right of use, 17,148. Then we go to subsequent measurement. Subsequent, I believe this one we have understood because this one we already discussed it when we started on initial cognition. I believe you have understood, my good friend Edwin. Edwin, I believe you have understood this good calculation there. Now we go to subsequent measurement. Subsequent measurement. Subsequent measurement. Now when we go to subsequent measurement, there is the right of use is depreciated. Subsequent measurement. Subsequent measurement. Right of use is depreciated. Therefore, let's depreciate the right of use. I will take 17,148 divided by 10 years, which is 1715. That is my depreciation each year. Thank you very much, Edwin. You say yes, you understood. Thank you very much. You say yes, you understood. Thank you very much. That is a very good gesture there. That is a very good gesture. Now, the right of use is depreciated on straight line basis. Therefore, you just take the amount of this liability, the amount of right of use you divide by number of years. Therefore, it is 17,115 there, 17,115. Then the lease liability is amortized. Lease liability is amortized on subsequent measurement. This liability we amortize to get what we thought at the end of each year. At the end of each year. Now let's amortize the lease liability. Let's amortize them. We prepare amortization schedule, and you need to remember that payments you are making them in advance. Therefore, we say year, principal balance. Then we have the installment, we pay it immediately, installment. Then we have capital balance. Then we charge interest. Then balance carried down there, balance carried down. This is how we prepare the amortization schedule when payments are made in arrears. We are only doing for 2 years. Examiner wanted 2 years. Therefore, we are only doing for 2 years. Don't make it too long. Don't waste that book. Remember, we need it in the next 2 months. We need that book. And we don't want you to incur extra costs because you have already paid school fees. Therefore, you should not incur other extra costs of buying a book. Therefore, you better save, and you remember the dollar is not now coming down. Our Kenya shilling is strengthening. Therefore, you can now release your dollars that you have been keeping now in the market. Now here, in year one, our principal balance was 14,398. Our installment is 2,500. But in year one, you don't put it there. In year one, you don't put it there. In your year one, you don't put it there. Why? Because in year one, we have already paid. You have already paid in year one. You paid at the beginning. Therefore, when you are amortizing installment year one, you have already paid, therefore you put a dash. Then my capital balance is 14,398. 14,398. Our interest charge is 10%. Now we charge interest on the capital balance, which is 14,440. I'm rounding off there. To the nearest, that was 14,339.8. Then I'm rounding off to 40. Therefore, Wazira, you can see you laughing. You make sure that you give us your dollars, because if you keep them, then you will incur more loss. You will incur more losses on dollars because now the shilling is gaining strength. in the next 6 months, we are going to gain strength in the next 6 months, although it's short term, but you need to take precaution. Don't keep your dollars because you will waste a lot of money there. Now, what will be our closing balance? Our closing balance is 14,398 plus 1440. I'm getting 15,838. 15,838 as my closing balance. And on closing balance, that is what I have. On closing balance. Then year 2, now my opening balance is 15,838. Now we are going to pay the installment of 2,500. 2,500. We are going to pay the installment of 2,500. Then I subtract here 2,500. I'm getting 13,338 there. 13,338. Then I charge 10%. 10% of that, 10%. 10% of this is 13,340. That is the 10%. 10%. Then out of that, I get 14,672. 14,672 at the end. 14,672. What are we subtracting this? Because payments are made in advance, therefore, we only charge interest on what is remaining after we have paid the installment. After we have paid the installment is when we charge the interest. You don't charge interest on the principal balance like when payments are made in arrears. Therefore, that is how we prepare the amortization schedule. That is how we prepare the amortization schedule. Now, what I know here now, we need to report our financial statement extracts, and we have 2 years. First year, we don't less 2,500, yes. And we don't less because, remember, we are making payments in advance. Therefore, in the first year, I have already paid. Therefore, it's not part of this liability. You can see this liability of 14 when you are discounting. We discounted only 9 years. Therefore, we subtracted that first year. First installment, we did not discount it. First installment, we did not discount. Therefore, it cannot form part of what? The liability. It's not form part of this because I already paid it. Therefore, in the first year, I have already paid. I will not pay anything. Then I get the capital balance. I charge interest on this. I get that. But in the second year now, I'm starting paying now. Second year, I'm paying like that. Now, let me prepare financial statement extracts. Let me prepare financial statement what? Extracts. I said we prepare for year 2. Year 2. We prepare for year 2, 2019. We start with profit or loss extract. Profit and loss extract. I have 2 years. Year 1, year 2. Year 1 and year 2 there. Therefore, here, I will start with finance cost. Finance cost. In year 1, finance cost was 1440. Year 2 is 1334. Year 2 is 1334. Year 1 finance cost is 1440. Year 2 is 1334. Then I come to depreciation. Depreciation. Year 1 depreciation is 1715. Year 2 is 1715. The same because it's straight line basis. Nothing is changing there. Because it is straight line basis. Now, I go to balance sheet extract. Statement of financial position extract, that is the balance sheet extract. Statement of financial position extract. I have year 1, year 2. Year 1, year 2. Then I come to non-current asset. Non-current asset. I have the right of use. In the right of use, I will take year 1, 17, 148 minus 1715 minus 1715. That is 17,148 minus 1715. In the first year, I have 15,433. In the second year, I take 15,433 minus 1715 again. I have 13,718. In the second year, that is what I have. Remember, you subtract depreciation on straight line. Each year you subtract depreciation of 1715. Each year you subtract depreciation of 1715. Then we come to current. We come to financed by section. Financed by section, where we have non-current liabilities. Non-current liabilities, I have this liability. Then I have current liability, where still I'm going to report the lease liability, which is current. I'm going to report the lease liability, which is current. Now, remember, when examiner asks you when payment is made in advance, whatever you have at the end of the year, like this one, year 1, I will take 15,838, but I less the installment. You less the installment. Why should you less the installment immediately, Biwaziri? Why should you less installment immediately? You take what is at the end. I believe you have seen, you take what is at the end. Then, when you take it, you immediately less the installment. Then you report as non-current liability. Why are you subtracting the installment immediately? Because the installment is not part of the non-current. Installment, you are just coming to pay it in the next year. Therefore, it's not a non-current liability. Therefore, like in this case, I'm taking 15,838 minus 2,500. Of course, I get 13,338. 13,338. That is my first non-current liability. Then in the second, I will take 14,672 minus 2,500. I get 12,172. 12,172. 12,172. That is current, non-current liability. You just take what is at the end, you less the installment that you are paying, because the installment you are just going to pay the moment you open the year, then it's not non-current. Then our current liability is the installment, 2,500, 2,500. In each year, the current liability is the installment. The current liability is the installment there. That is when payment is made in advance. That's how you report when payments are made in advance. Any questions so far? I know we are moving on fast because of the constraint of time, but we shall overcome. You are my very good people. We shall overcome. Any questions so far as we move on? If there is no question, then we go to what we call sell and leaseback. Sell and leaseback transactions, sell and leaseback. We go to what we call sell and leaseback. If there is no question, I know you are very well. Therefore, we go to what we call sell and leaseback transactions. Sell and leaseback. Sell and leaseback. We need to know what is sell and leaseback. Sell and leaseback. Sell and leaseback. Sell and leaseback. Now, when we talk of sell and leaseback, this is where the asset is yours. The asset is yours. That's my good friend Waziri. The asset is yours. You have a very good car, a very good pickup. But remember, you have money constraint to do business. You don't have enough money to do business. Therefore, what is the pickup for? You cannot perform anything. Therefore, what you do, my good friend Waziri, you sell the pickup to Mwalimu. You sell it to me, then Mwalimu gives you that 2 million, then you get money to do business. After you get that 2 million from Mwalimu, then you talk to Mwalimu very nicely that now, give me that car, that pickup, so that I use it to carry cabbages from Lamu to Mombasa. You carry cabbages from Lamu to Mombasa, so that you make a lot of money there. That is now where we call sell and leaseback. The asset is yours, but now you sell the asset, you get the money. After you get the money, then you again lease the asset back now to use to generate more income. To generate more income. That is what we call sell and leaseback. Sell and leaseback. Now we can say, you can introduce and say, a sell and leaseback transaction, a sell and leaseback transaction, sell and leaseback transaction occurs, sell and leaseback transaction occurs when one entity, that is seller, one entity, seller, sell and leaseback transaction occurs when one entity, seller, transfers an asset to another entity, transfers an asset to another entity, that is buyer in bracket, buyer, who then leases, the asset back, who then leases the asset back to the original seller, who then leases the asset back to the original seller, Then you continue to say, the companies are required to account for the transfer contract. The companies are required to account for a transfer contract, and the lease transfer contract and the lease applying and the transfer contract applying IFRS 16, 16. Applying IFRS what? 16. Applying IFRS 16. Applying IFRS 16. However, we put however, consideration must first, consideration must first, consideration must first be given to whether, consideration must first be given to whether the transfer, then to whether the initial sale of the transferred asset. Consideration must first be given to whether the initial sale of the transferred asset, initial sale of the transferred asset is a performance obligation, as per IFRS 15. As per IFRS 15. However, consideration must first be given to whether the initial sale of the transferred asset is a performance obligation as per IFRS 15. Now, I want to ask you a question, very simple one. Now, we are saying that when we have to account for this transfer contract, we are first going to give the consideration to the provisions of IFRS 15. My question is, what does IFRS 15 say? What are the provisions of IFRS 15? That is my question to you guys. What is the provision of IFRS 15? Because we are saying for us to account for that lease and transfer contract, consideration must be given to the IFRS what? 16. IFRS 15. What does IFRS 15? Now, IFRS 15 says revenue from contracts with other customers. Revenue. IFRS 15, that one we discussed revenue from contract with customers. Revenue from contracts with customers, that's IFRS 15. Now, what we are saying here, remember you are selling an asset to another person, then you lease it. Therefore, for us to account that it's a sale and lease back, then we need first to consider, was it a sale? Did I recognize the purchasing company? Did I recognize the revenue from this customer as per the requirement of IFRS 15, revenue from contracts with customers? Because when we go to revenue from contract to customers, there are the provisions that will tell us that now this sale qualifies a transfer contract. It qualifies. Therefore, if it does not qualify, then you cannot recognize that as revenue. Therefore, that's why we are saying for us to account for this list, it must be qualified, it must qualify the transfer contract as per IFRS what? 15 first. Consideration must be given to that. Now let's see how to account for sale and leaseback. Let's see how to account for the sale and leaseback. How do you account for the sale and leaseback? You say how to account for the sale and leaseback. How to account, or how to recognize. Let's use the word recognize. How to recognize? To recognize sale and leaseback. How to recognize sale and leaseback? How to recognize sale and leaseback? Number one, recognize sale proceeds. This one you debit back. Recognize sale proceeds. Remember here, you are selling the asset. You are selling the asset, therefore you recognize the cash. That sale proceeds by debiting what? Bank. You are selling the asset, therefore you receive money. After you have received money, you go to number 2. They recognize the asset. You recognize the asset. You credit bank. You credit bank. They recognize the asset. You credit bank. Sorry. You credit asset. Let me repeat twice. You credit asset, not bank. When you receive money, you debit bank. When you sell the asset, you recognize it, therefore you credit asset account. Then number 3, now after selling the asset, now you lease it. You lease this asset, therefore recognize this liability. This liability, here you credit this liability. You credit this liability, you recognize the lease liability there. Now you are leasing the asset after sale. Then number 4, recognize the right of use. Recognize the right of use, whereby you debit ROU. You debit the right of use there. You debit ROU, which is you debit the right of use. You debit the right of use. Debit the right of use. Then, lastly, number 5, recognize the gain or loss. Recognize the gain or loss as the balancing figure. As the balancing figure on the rights. On the rights transferred to the buyer. On the rights transferred to the buyer. Now, let's go for a short break or hard break of 5 minutes. When we come back, I come to explain number 5. When we come back, I explain number 5. Therefore, stay tuned. Just a break, a health break to take some water. I know you are at the comfort of your house. You can take some juice there. Then you come back immediately after some 5 minutes, and then we explain that thing. Proceed now. Thank you very much, Ruth. Now, we were saying that how to recognize sale and leaseback. First, you are going to recognize the sale proceeds. The money you have received, you debit your bank, you take it to the bank. Then you recognize the asset, recognize the lease liability after you have leased the same asset, recognize the right of use, then recognize the gain or loss as the balancing figure on the rights transferred to the buyer. Now, initially in IAS 17, remember, previously we were using IAS 17. For example, the fair value of the asset is 200. Then the carrying amount, the book value is 100, or let me say 120. 120. Definitely, you had a gain of 80. You had a gain of what? 80. That is what we recognize according to IAS 17. But when we change to IFRS 16, my brothers and sisters, now we don't recognize this gain. We don't recognize the gain of 80. What are we going to recognize? Remember, when you have the asset, you are transferring to another person, then you lease it back. Then the standard is dividing them into 2 rights. The standard is dividing that into 2 rights. Number 1, the rights you have retained to yourself. Number 2, the rights you have transferred to another buyer. Therefore, you are only required to determine the gain on the rights you transferred to another buyer. That is why we are going to recognize it as a balancing figure, there. That is why we are going to recognize it as a balancing figure. Now let's proceed. Now let's know what is the lease liability under sale and leaseback. What is the lease liability? Lease liability. Lease liability, of course, it will remain the present value of minimum lease payments, minimum lease payments discounted to at the implicit rate in the lease. It will remain present value of minimum lease payments discounted at the implicit rate in the lease. Present value of minimum lease payments discounted at the implicit rate in the lease. It will remain like that. What about the right of use? Right of use. This one will change kindly. Make sure you write. Right of use. We say recognize the right of use asset, as a proportion of the previous carrying amount, of the underlying asset, Recognize the right of use as the proportion of the previous carrying amount of the underlying asset, Now, how do you get the right of use? Right of use equals to, you are going to take the lease liability, multiplied by fair value of the asset, then you multiply by the carrying amount of the asset. You take, how do you get that? We are saying you are going to get it as a proportion of the previous carrying amount. Therefore, for me to get the lease liability, the right of use, I will first have the lease liability. I divide by the fair value, then I multiply by the previous carrying amount to get what we call the right of use. That's how you get the right of use asset there. That's how you get the right of use assets. That is how you get the right of use assets. Now, you can put a note and say, put a very good note there. Put a note and say, if the proceeds are less than the fair value of the asset, if the proceeds are less than the fair value of the asset, or lease payments are less than market rentals, or lease payments are less than market rentals, the following adjustments are made to measure. The following adjustments are made to measure the sale proceeds at fair value. The following adjustments are made to measure the sale proceeds at fair value. The following adjustments are made to measure the sale proceeds at fair value. The following adjustments are made to measure the sale proceeds at fair value. Number A or number one. Number A or number one, you say any below market terms, any below market terms, any below market terms, any below market terms, any below market terms should be accounted for as a prepayment. Any below market terms should be accounted for as a prepayment. Any below market terms should be accounted for as a prepayment. And any above market terms, should be accounted for as additional financing provided in the lease. Any above market terms should be accounted for as additional financing provided in the lease. Any above market terms should be accounted for as additional financing in the lease. Kindly pardon that statement. Which statement now? Which statement? Because I was saying that I put a note. Let me repeat the same note. I said in the note, if the proceeds are less than the fair value of the asset, if the proceeds are less than the fair value of the asset, or these payments are less than the market rentals, these payments are less than market rentals, the following adjustments are made. The following adjustments are made to measure the proceeds at fair value. The following adjustments are made to measure the proceeds at fair value. Number one or number A, we said, any below market terms should be accounted for as a prepayment in the lease. Any below market terms should be accounted for as a prepayment in the lease. Then number two, I said any above market terms should be accounted for as additional financing provided in the lease. Any above market terms should be accounted for as additional financing provided in the lease. This is what Marim is saying. Marim is saying this. Fair value of the asset is 200. Fair value of the asset is 200. I think, Ruth, you have seen 200 there. Marim is writing 200. That is the fair value of the asset, 200. Then when you sell this asset, you can either receive more or less. Now, let me assume you received 150. Instead of receiving 200 fair value, the buyer of the asset gave you 150. The buyer gave you 150. The buyer of the asset gave you 150. Therefore, it means he gave you less than what you are required to receive. He gave you less than what you are required to receive from the sale of the asset. Therefore, that one, we call it a prepayment. I have prepaid by 50 because the fair value is 200, but you gave me 150. Therefore, I have prepaid this asset by 50 million. Or the fair value of the asset, my good friend Ruth, is 200, but for you, you are giving me 300. Because maybe I need a lot of money. I need a lot of money to do business. Therefore, although we agree that although the fair value of the asset is 200 million, but 200 will not be enough for my business. 200 will not be enough for my business. Then what do we do? Add me some more money. Add me some more money. Then you are giving me 300 instead of 200. Therefore, you are adding a liability. That's why we are saying it's an additional financing provided in the lease. Additional financing provided in the lease, we are going to increase the liability there. But if it is below, you gave me less, then for me, I did a prepayment. I did a prepayment to you. I did a prepayment to you. That is what we are saying there. I did a prepayment to you guys. Now, kindly, let's look at one question. Unless somebody has a question, let's look at a question of December 2021, question number 3A. December 2021, question number 3A. Let's look at the question of December 2021, question number 3A. December 2021, question number 3A. When you are there, you say yes, Mwalimu wants to move very fast. Oh, Mwalimu is already there. December 2021, question number 3A. Harry Limited. Harry Limited is our question of reference. Harry Limited. Harry Limited, I believe you are there. Harry Limited. It says, Harry Limited sold a building at a fair value of 112 million. Fair value that I'm talking about, this one, we sold a building at a fair value of 200 million to a finance company on that 1st October 2020, when its carrying amount was 78.4 million. The building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years, so that it could be concluded that control of the building had transferred to the finance company. Lease rentals are 98.56, payable annually in arrears. The interest rate implicit in the lease is 7%. The present value of annual lease payments was 43.20. Harry Limited recorded the cash proceeds, they recognized the building, and recorded the profit on disposal of 33.6 million in the statement of profit or loss. No other accounting entries had been posted. Required, with reference to International Financial Reporting Standard IFRS 16 leases, and with suitable calculations, explain the accounting treatment of the above transaction in the financial statement of Harry Limited for the year ended at 1st October 2021. 8 marks for free. Examiner sometimes wishes us success. Examiner sometimes wishes us success. This was a December gift to many students. December gift, especially my students, it was a gift. Especially to my students, it was a gift. Let's do the analysis of this question. Let's do the analysis of this question. Now, Harry Limited, that is the lessee. That is the lessee. Then, this period is 5 years. This period is 5 years. This period is 5 years. This payment is 98.56. This payment is 98.56, payable in arrears. Payable in arrears. This is very important, payable in arrears, because if you miss this, then you can mess up the question. Payable in arrears. Interest rate implicit. Interest rate in the list is 7%. 7%. Therefore, in a question like this, where do we begin? In a question like this, where do you begin? You begin by looking at the lease liability. This liability, which is the present value. Present value. But in this question, examiner gave us the lease liability of 43.20. Already the examiner gave us that, but if examiner did not give us that, I believe as of today, you know how to discount to get that lease liability. If you don't know, you just say, Mwalimu, you're going, but I know you are my very good students, you cannot forget that to get the lease liability. But examiner was wishing us success because he already gave us the lease liability. Then we get the right of use. right of use, which equals, we say we are going to get it as a proportion of the previous carrying amount. Therefore, I take the lease liability of a fair value times the carrying amount, which equals to my lease liability is 40,320. The fair value of the asset was 112. Then we multiply by the carrying amount, which was 78,400. Then I believe my good friend Ruth will be gracious to Mwalimu to give him the right of use. My good friend Ruth, just be gracious to Mwalimu and give me the right of use as a proportion. Give me the right of use there. The right of use, we are going to get it as a proportion. All these figures are just in the question. Mwalimu has not generated any figure there. When you go to 4320, it's already in the question. Fair value of 112 is in the question. The carrying amount is also in the question. 28,224. Thank you very much, my good friend Ruth. 28,224. That is the right of use. That is the right of use. Now that we have the fair value, we have the lease liability, we have the carrying amount, we have the right of use and everything. Let's recognize sell and leaseback. Let's recognize sell and leaseback. We said how do we recognize sell and leaseback? Let's recognize sell and leaseback. We said we recognize the sale proceeds, therefore we debit bank. You debit bank, we received 112. We received 112. We debit bank, that is the sale proceeds. You debit bank. Then we recognize the asset, credit asset, 78,400. We recognize the asset, 78,400. Then we recognize the lease liability, credit lease liability, 4320. Credit the lease liability, 4320 there. Then lastly, we recognize the right of use. We debit the ROU, right of use 28,224 as per my good friend Ruth. As per my good friend Ruth. You debit ROU as 28,228. Now that's what we said. We recognize the right of the sell and leaseback. Then now you balance this debit, you subtract from the credit, you take the debit, you add, you take the credit, you add, then to find the difference, that one will be either gain or loss. I know my good friend Edwin has not understood what I have said. Edwin, this is what I have said. This is what Marim is saying. In this, when you check on our recognition, we said we have the gain or loss on the rights transfer to the buyer. Then we said we get it as a balancing figure. Edwin, we said you get it as what? A balancing figure. How are you going to get it as a balancing figure? In this journal entry now that we have, what we received from the asset, what we recognize the asset, what is the lease liability, what is the right of use, then you are going to balance the debits and the credits. The difference is what we call either gain or loss on the rights transferred to the buyer, the difference. Now, who can give us the difference between the debit and the credit? As you can see, we have the 2 debits, 2 credits. Therefore, we want the difference. Who can help Mwalimu there? Apart from Ruth, who can help Mwalimu there? Thank you very much, Ruth. 21,504. Therefore, we credit. That is the gain. 21,504. 21,504. Therefore, we have recognized sell and leaseback there. The aim of doing this is to recognize this gain or loss, this one. That is what is making us do the recognition there, so that we find either gain or loss on the rights transferred to the buyer. Therefore, here we have the gain of 21,544. Now, let's go back to our question. Let's go back to our question. I believe you are following the instructions so that we understand. When we go back to our question, let's go back to our question. Examiner gave us that a head limited recognized the gain on sale of that 3.6. That is that 3,600. Examiner told us that we recognize that gain. How did we get that gain? I think you are listening so that you not ask it again. How did the examiner call that gain? It was the fair value of 112 minus the proceeds of 78.4. You get 33.6. You get 33.6. That is what they recognize. But now, according to IFRS 16, you can no longer recognize this gain. You can no longer recognize that gain. You only recognize the gain on the rights transferred to the buyer, which means you get it as a balancing figure. As a balancing figure, like you can see 21 and 33. There is something that is getting lost in between of like 10 or 11,000. Therefore, that 10 or 11,000 is the rights on the gain on the rights we retained. Now, after we have this, we go to subsequent measurement. Subsequent measurement. Quickly, we go to subsequent measurement so that we complete this question. This is just on initial recognition. Subsequent measurement. Let's go to subsequent measurement. Subsequent measurement. Subsequent measurement. The right ROU is depreciated. ROU is depreciated. Therefore, I'm going to take 28,224 divided by 5 years. How much is my depreciation? How much is my depreciation? It is 28,224 divided by 5. I'm getting 56.45. That is depreciation for 1 year. 56.45. 56.45. Then this liability is amortized. Therefore, I'm going to prepare what we call amortization schedule to get the liability. Amortization schedule. I said here, principal balance. This one payment is made in arrears. Then we are going to charge interest on the principal balance. Interest is with installment. Then balance carried down. Balance carried down there. We are only doing for 2 years. Don't make it too long. We are only doing for 2 years. Don't make it too long. We are doing for 2 years. Only we are doing for 2 years. In fact, examiner wanted 1 year, but we are adding another one because I already explained why should we add another one. We are only amortizing for 2 years, for 2 years, for 2 years. Therefore, in year 1, my principal balance is the lease liability of 40,320. My interest was 7%. Installment that I'm paying is 98.56. This one is the question. 98.56 is the question. Examiner told us that the installment is 98.56. Therefore, 0.7 times 40, 320, 28. That is my interest. That is my interest. Therefore, I take 40, 320 plus I'm having 33, 286, 286, 33, 286, 33, 286. Then in year 2, I bring here 33, 286. I charge interest on it. And 330. My installment is 98.56. I'm having 25,760 like that. 25,760 like that. 25,760. That is our amortization schedule when payments are made in arrears at the end of the year. When payments are made in arrears, that is at the end of the year. Payments are made in arrears, that is at the end of the year. Now, what we need is how to report. What are we going to report? Let's prepare the P&L extract. P&L extract, profit and loss extract. I have here one. That is, we are going to recognize finance cost. Finance cost, our finance cost is 28. That's 2822. In the first year. Then depreciation is 5645, 5645, 5645, 5645. Then I report the gain on the rights transferred to the buyer of 21,544. I recognize the gain on the rights transferred to the buyer, that is 544. The gain on the rights transferred to the buyer of 544. I'm putting in the bracket because it's a credit balance. Somebody may ask, Mari, why are you putting the gain in bracket? Remember, these are expenses, we debit P and L. These are gain, you credit P and L. Let's prepare balance sheet extract. Let's prepare balance sheet extract. Statement of extract. Here we have year one. We start with non-current assets. Non-current assets there. Right of use. Right of use will be. Right of use will be. I will take 28,224 minus 56,45. 22,579. That's what I report at the end, 22,579. Then I come to financed by section. Here I have non-current liability. Where I have this liability. Then I have current. Where we have this liability there. Waziri mwalimu umesema 22,579 umepataje? That is the right of use at the end. We take the carrying amount, what was the right of use originally on recognition, which is 28,224 minus depreciation, cost minus depreciation. Thank you very much, ICE on the price. Thank you very much. Even your name is good. The ICE is on the price. Thank you very much. The ICE is already on the price. Thank you very much. 28,224 minus the depreciation. That is how we call the right of use. We subtract depreciation at the end of the year. Then, lease liability. This is where you need to listen. Examiner asks year 1, but you always prepare for year 2. I'm just repeating what I already said. Examiner asks for year 1, you do year 2. Therefore, if you are going to do year 2, we take here 25,760 as our liability, non-current liability in year 1. You take the one for the subsequent year. You take the one for the subsequent year. Then, when you come to the current liability, you take the difference. Current liability was in, you take the difference, which is 33,286 minus 25,760. 75,26, 75,26, 75,26, the current liability. That is what the examiner wanted to give you 8 marks. That is what the examiner wanted to give you 8 marks. 8 marks. Examiner wanted that to give you 8 marks. Therefore, because of time, we cannot continue and proceed. We cannot proceed because of the constraint of time. I believe we meet in our next class. We look at fair value measurement. Then we go to reconstruction. Therefore, we are starting doing serious items. Now we are almost done with topic number 1. When we do fair value measurement, that one will take us like 30 minutes. We are done. Then we go to reconstruction. Reconstruction. Therefore, reconstruction is our next big agenda. Reconstruction. Thank you for your time. May the Lord keep you safe, sound, and secure. We meet on Monday. We meet on Monday. We meet on Monday. Thank you very much, Ruth. You say, my good friend, thank you very much. Thank you very much. Thank you very much.